We think that with all those particular metrics in place, that the credit ratings will maintain BHP's credit rating at this particular time.
David Lennox, Happy New Year. Welcome back to Dukascopy TV.
Natalie, thank you very much for having me for interviewing again in 2016.
No problem at all. So with that said, let's jump straight in. And our latest minor drama, as it were, is this consideration of BHP's AAA credit rating and the fact that they could in fact be set to lose it, as Standard & Poor's say that they're going to be looking into reviewing their credit ratings for the miners. Is BHP at risk, do you think?
Look, you'd have to have a look at the environment that BHP finds itself in, and that is a very turbulent one in terms of all the commodities that it trades in. We've seen very low commodity prices, and of course that's put a lot of pressure on the structure of BHP, both its balance sheet and of course its profit and loss. So there are a couple of key things that credit companies look at. They look at the stability of the industry that a company's in, and they also look at the stability of the company itself. You'd have to suggest for BHP that its industry is not at the moment very stable because of those low commodity prices, but BHP itself is actually quite stable. If you have a look at what the company's done in the past 3 years, it's lowered its cost structures, it's reduced its capital expenditures, and it's also increased its volumes to try and take advantage of volume variances. We think that with all those particular metrics in place, that the credit ratings will maintain BHP's credit rating at this particular time.
Now, something that BHP has always stuck very strongly by is its progressive dividend policy. You mentioned there, strong balance sheets. What role has this both aggressive and progressive dividend really played for BHP?
Look, you'd have to suggest that the first thing is the impact that dividends have on the company, and that's on its cash flows. You've got to have the cash to actually pay a dividend. BHP has in the past had no problem generating cash flows from its significant asset base. However, as we have seen revenues decline over the past couple of years, that cash base is still there, but it is significantly smaller. That puts pressure on BHP's earnings, because as earnings fall towards the dividend amount, it does leave it less and less room to actually pay those dividends. So we do think that because BHP is a price taker in the commodities market, it will at some time probably look at certainly addressing its progressive dividend policy. It may not change it, but it will certainly have a look at reviewing it. And primarily that is because when you are a price taker, you can't dictate the actual revenues that you're going to earn and the cash flows that you're going to earn year on year on year. That's actually dictated to you by the market. So if you've got a progressive dividend policy, if you can't forecast what you're going to earn in a particular year, that makes it difficult to actually pursue that policy.
Now, iron ore prices, as we know, have really struggled in terms of the production downside that we're seeing. That said, BHP are actually expecting greater production. Meanwhile, companies overseas, such as Vale, are expecting to pull back on iron ore production. Is it such a surprise that we have these supply, price, demand imbalances?
Oh no, certainly it isn't. And again, we've got to cast our eyes back a number of years when China was a very small player in the global economy. Over the past 10 years, that economy has gone from about $1 trillion US dollars up to $10 trillion US dollars on GDP, where it is currently standing. With that escalation in growth, it required a significant quantity of commodities, and one of those commodities was iron ore. And of course, there wasn't the supply to actually meet that demand as China grew throughout the last decade. Now that the company has actually reached its plateau of growth, we have seen excess supply of iron ore because projects have kept coming onto the market, but the supply for those projects is no longer fully there. So we do think that going through the remainder of 2016, that there will be significant pressure on the iron ore price, and that's probably to the downside, primarily because we will see these projects come into final completion, and then, as we are seeing now, we'll see capital fly out of the market, and then we'll start to see the demand-supply imbalance start to redress.
David Lennox, many thanks for the update.
Thanks. Thank you, Natalie.
Our many thanks, as always, to David Lennox at Fat Profits for his comments. For more insights into the commodities and resources sector, do stay tuned for the Dukascopy TV team's Commodities Corner interview. I'm Natalie MacDonald. You've been watching Sydney Direct on Dukascopy TV. I'll see you next time.